Hello friends, Chris Lee, CPA here, back with another video for you. So today we are going to talk about what counts as taxable wages for your employees. So when it comes to payroll, one of the misconceptions that both employers and employees have is the definition of what is wages and what is taxable. So the main misconception is that wages mean only salary or hourly pay to the employees. But when it comes to reality, taxable wages have a much broader definition, and it includes cash payments, non-cash items from the employer, and also fringe benefits that must be properly valued, taxed, and reported. And so this comes from a variety of statute. So the fundamental concept of the fundamental statute that gives us these consequences are, Code Section 61, which applies to all taxpayers in the United States, which basically says all accretion of wealth is taxable unless otherwise deemed not taxable. So this is to say all taxable wages from an employer to an employee, which includes all remuneration for services performed by an employee, is going to be subject to federal income tax and federal income tax withholding. So when we talk about payroll tax, we have a couple different things we need to think about. Is it taxable? And then is it going to be subject to withholding? And then what types of withholding is it going to be subject to? Is it going to be subject to income tax withholding? Is it going to be subject to Social Security or Medicare tax? Is it going to be subject to unemployment? And then there's also the applicable state and local taxes that are going to apply. So that could be state income tax, that could be the state disability income requirements to be withheld upon, or even state unemployment. So there's a lot of different types of tax that come into payroll that we have to think about. And so we just need to think that our default position is all benefits paid to the employees are taxable unless otherwise deemed not taxable by the tax code. So this is not only by statute, and we've got several regulations that support this, but this is also comes down and is explained by the IRS in their publications. So when we think about authority of tax guidance, we've got the tax code, which is the legislation that's enacted by Congress. Then we have the regulations, which are promulgated by the Secretary of the United States, the Treasury, which is also generally the arm of that constitutes that is going to be the Treasury Department, which is to say the IRS. So these are formal guidance that must be followed by the IRS, formal guidance that is, tags along with the tax code, and these are treated as tax law. And the only time that they aren't is if they explicitly impose rules that go against the language included in the codified legislation. So regulations are law, and unless they, do something completely, try to enact a rule that is in contrast or completely against what is outlined in legislation. Anyway, so when we think about taxable compensation, we kind of need to go beyond the idea of what is taxable wages, and we need to go to what is taxable compensation. So compensation can be any accretion of wealth to your employees, and that includes benefits. So the first thing that is basically always taxable is cash compensation, which is pretty straightforward. We can understand that. That would, oftentimes be, regular wages and salaries, overtime pay, commissions, bonuses, back pay, or any amount of retroactive pay. Those are all taxable wages. Now, with that said, the recent legislation in July of 2025, the One Big Beautiful Bill Act, the OBA, and it enacted some legislation that makes overtime pay somewhat non-taxable, and the only piece that is non-taxable is the rate differential. So if you had someone that's regular rate is $20 an hour and their overtime rate is $30 an hour, It's just that $10 differential between the $30 and the $20 that is not taxable. For certain eligible taxpayers, there are certain thresholds that apply. So employers are going to be responsible for withholding on all overtime pay and then reporting to their employees the amount of what the total amount of overtime differential that was paid to them, so that on their personal tax return they can do all the math to determine what is not taxable to them, what is non-taxable overtime pay. So cash compensation, basically always taxable. The next category we have is going to be non-cash compensation, which is taxable unless otherwise excluded. So examples of this would be gift cards or gift certificates, really in any amount to your employees, prizes and awards tied to performance, personal use of employer-provided vehicles, employer-paid club or gym memberships, or non-qualified relocation reimbursements. So non-cash compensation is common for payroll errors, and the IRS treats these non-cash items as wages at the fair market value unless there's a statutory exclusion that would apply. So one thing to keep in mind is that cash equivalents such as gift cards never qualify as de minimis benefits, even if the value is small. The IRS has been pretty explicit about this. So again, we've got the cash compensation, basically always taxable. Non-cash compensation is going to be taxable unless excluded. And then we've got fringe benefits, which are taxable by default and excluded by exception. So you can actually look at the IRS publication 15B, which outlines, the fringe benefits are taxable unless excluded, and it gives you basically a nice exhaustive list of, the most common types of fringe benefits and how they're treated. So commonly taxable fringe benefits are cash or cash equivalent awards, think gift cards, personal use of employer-provided cell phones when not primarily business related. There's tuition assistance that is above a certain threshold. Currently, that threshold is $5,250 per year. And another, fringe benefit are moving expense reimbursements. Exceptions apply for military moves, but otherwise, employee moves and that assistance is a taxable fringe benefit. So commonly excluded fringe benefits, those are excluded from, taxable compensation, are employer contributions to group health plans, dependent care assistance up to $5,000 annually. That applies for, tax years 2025 and before. Starting in 2026, the dependent care assistance goes up to $7,500 a year. This is as a consequence of the July 4th legislation of July 4th, 2025 legislation, and the One Big Beautiful Bill Act. So qualified transportation benefits can be excluded, but there are monthly limits to this, so the calculation can get a little interesting there. But these amounts are updated annually. De minimis benefits of minimal value provided infrequently. So this would be non-cash items that are considered de minimis. Again, this isn't going to be gift cards. And then we've got working condition benefits directly related to an employee's job. So failure to meet, the statutory conditions for all these items to be qualified, which all have individual rules to them, does result in the entire value being taxable, and it's not just the excess benefit that might be over, threshold amounts or not. So it's really important to understand what are the consequences of these types of benefits and how they're going to be taxed, and that it's set up properly. The one thing that also, when we think about these items is that the landscape of determining what is taxable and kind of the calculation of certain items is not just a function of the IRS, but we actually have to look at the Department of Labor and understanding the Fair Labor Standards Act, but then also certain states have different rules as well. So while the Department of Labor doesn't define the taxability of benefits, they determine whether certain taxable payments must be included in the employee's regular rate of pay for overtime. So this makes the complications a little bit, funny in some ways of how we determine like the overtime rates when we think about this. And one example of this is non-discretionary bonuses that are maybe related to attendance or productivity or safety bonuses. They're going to be included when calculating overtime. So that makes when you put a bonus into a pay period where there is also overtime for that employee, it basically starts bumping up the overtime rate for that position. So in the example of, the $30 an hour overtime rate versus the $20 an hour regular rate, if there is also a bonus in that period, the overtime rate might end up at $32 an hour rather than $30 an hour. So that's the way, something that has to be thought about when we're talking about compensation items as well. And then there are also some additional items at the state level. So states may tax benefits that are excluded federally. Some states may have different unemployment wage bases, and then there's also paid family and medical leave programs that that might have unique federal and state tax treatment. So employers must evaluate wages by tax and by jurisdiction, not just in the aggregate. And this is where having employees that are maybe dispersed across different states could have some interesting consequences. For example, like California requires that certain employers reimburse employees for the use that work from home or remote, reimburse them for home internet. That's essentially an employee paid item that is an expense of the business, and so California has a rule that requires reimbursement for that. So just some things to think about. So to give like a bit of an illustration and kind of talk through this, let's imagine an employer provides a $250 holiday gift card in December. They provide employee paid cell phone with an $80 per month amount attributable to personal use, not business use. And then they have, $6,500 in graduate tuition reimbursement under an employer education plan. So at year end, the payroll needs to determine what portion of these amounts must be included in the taxable wages, basically what's going to go on the W-2. So the first compliance question is not, is this taxable, but whether, is there an exclusion for this? So we need to stop thinking about, is this benefit taxable? We have to think, is there something that makes this not taxable? So with these, all three items mentioned, there are forms of compensation connected to employment. So each must be tested against an applicable exclusion. If no exclusion applies, or if the exclusion is limited, then some or all of the value becomes taxable wages. So you have to then analyze each item individually. So let's consider the $250 holiday gift card. So gift cards are considered cash equivalents, and IRS guidance explicitly states that cash equivalents cannot be excluded as de minimis fringe benefits, regardless of the amount or the frequency. So because there's no exclusion, the full $250 is taxable wages, subject to income tax withholding, Social Security, Medicare, and then applicable state and local taxes. So this is going to be on a W-2 reported in box 1, 3, and 5, which is to say the wages that are taxable for federal income tax, for Social Security tax, and Medicare tax purposes. Next, we have to think about the cell phone. So the question is, how much of this can be excluded? So employer-provided cell phones can be excluded from wages when provided primarily for valid non-compensatory business reasons. This would be after-hours availability or regular client contact. When that's the case, both business use and personal use are generally excluded from income under IRS Notice 2011-72. So let's assume an employer cannot substantiate that the phone was provided primarily for a non-compensatory business purpose, and so therefore the business is going to treat the phone as a compensatory perk. So as a result, the personal use portion must be included in the taxable wages. So the employer determined that $80 per month represents personal use. At $80 per month times 12 months, $960 is taxable. So the result, the personal use portion is going to be taxable. $960 is going to be imputed as wages, and the employer must, can impute this monthly or as a year-end adjustment to payroll. So failing to properly evaluate why the phone is provided and to document the business purpose is a common audit issue. So next we can, move on to the graduate tuition reimbursement. So federal law allows an exclusion for qualified educational assistants up to $5,250 per year. This amount is indexed for inflation starting in 26, so we expect to see that amount going up. So then we've got the exclusion applies even if the education is not job related. It's an employer provided perk. So the calculation is going to be the total reimbursement that we've got to our employee, which given our scenario is $6,500. The annual exclusion limit is $5,250, which means the excess of that exclusion limit becomes taxable, and that is $1,250. The result, they've got a $6,500 benefit to the employee. $5,250 is excluded from wages. $1,250 is taxable on the employee's Form W-2. Now, this is not to say any amount that gets excluded becomes, non-deductible to the employer. It's still deductible by the employer, it just also becomes taxable by the employee. So, the residual part that doesn't have that exclusion. So this is the same for all these provisions, is that, it doesn't limit the deductibility. It just changes whether or not there is a tax burden to the employee. So when we talk about these items. So then the first, like I said, our first step is going to be evaluate, start at our default rule and ask, is there an exclusion for this benefit to this employee? Then you take all the items that basically all the items and benefits paid to the employee and evaluate them separately. And then the step three is, total the taxable wages for the fringe benefits. So when the taxable portions are aggregated, we've got a gift card at $250. We've got a cell phone that is personal use at $960. And then we have a tuition reimbursement in excess of the threshold at $1,250. So our total additional taxable wages are going to be $2,460, which must be added to the taxable wages for withholding and reporting purposes. So we can see that, the more benefits you start offering your employees, the more, you have to think about some consequences here. So this is, so just to, at the end of the year, when we're doing kind of a compliance checklist, we need to identify all forms of compensation, including non-cash and fringe benefits. We got to confirm the taxability by type. That could be federal income tax consequences. That could be FICA tax consequences, which is Social Security, Medicare, and any unemployment issues that we need to think about at federal and state levels. And then we apply the proper valuation rules using fair market value when it's required. Then we'll impute taxable benefits timely, no later than the last payroll of the year. And then we'll reconcile forms W-2 to the quarterly returns to cash discrepancies early. So the most important thing is to, be clear and be consistent with the wage classifications with all the items that you're running to make sure that you reduce audit risk and ensure the accuracy of the year-end report. So just think about this as we're in kind of, year-end W-2 items, thinking about the last payroll that we've run in the year and are there any items that need to be reevaluated. And with that, I'll leave it to you, leave this video here. You'll be able to find my contact information in the link below. And if you want to have a direct conversation about your business or, some tax planning issues, feel free to reach out. So new video for you soon. Take care. Cheers.